Welcome to Legendary Exits, conversations with purpose-driven entrepreneurs. In this series, we sit down with the leaders and legends who turned their exits into opportunities for impact. We explore living lives of significance, leveraging exits to fund personal and financial goals, and building a best-in-class business along the way. You ready? Let's dive in.
Hey, I'm Micah Brandenburg, and I'm excited about today's conversation with Nick Bradley. Nick is a fellow exit advisor, but he brings a perspective that is really unique and different than most of us have. And that is a perspective of actually having run private equity companies after the acquisition. He's had a number of exits. He's had a number of companies that he's been involved with. And I'm super excited to have this conversation with him. Nick, welcome to the Legendary Exits podcast.
Thank you, Micah. It's a pleasure to be here, and I'm happy to go anywhere you want to take the conversation today.
Wonderful. Well, first off, we love a great UK accent when we listen to stuff in the US. But tell us where you're from and where
you're
going
to love this. I'm actually Australian, and oh
boy, I've gotten it totally wrong.
No, you're good. No, you're fine. Let me explain. I moved here 23 years ago. So Sometimes people confuse the accent to be like South African or something, because originally I grew up in Australia, left when I was in my late 20s, and I've been here ever since. So you get a blend of both today, which is good.
And of course, if you told me you were from South Africa, then the number one question would be, do you know Elon? So we'll move on from that one.
No, I do not.
Well, I'm excited for the conversation and a couple places I want to go today. But one of the things that I want to kick off with is I know that you have recently published and launched a new book, Exit for Millions, The Private Equity Blueprint. What made you decide to publish that book? Why was now the right time to sort of pull back the curtain and share your insights from a private equity point of view?
So, you know what? This is one of those things that I often say it's a one and done. Right? It's taken me 2 years to write it. And the reason for that is that I wanted to, maybe I was a little bit too much of a perfectionist around it, but I left private equity officially in 2018, and I had some really interesting experiences towards the end. In fact, I could argue that those experiences were sort of always there, right? You know, in the 12 or so years that I was in that sort of environment. But I decided that I wanted to demystify all the things that you hear about private equity and be really real about what I saw and what I experienced. At the same time, I also wanted to level the playing field when it comes to what private equity does and how to win what I think is effectively a game. And every game has rules.
Yes.
And if you don't know those rules, you know, you can not only lose the game, you can get taken advantage of. So it's very much about, you know, making sure that founders understand that environment.
Yes. Let's launch into several things you brought up there. Demystifying. What do you think? First off, tell us what you were doing in the world of private equity. Where did you glean these insights from? What point of view were you in the whole private equity ecosystem? But what are those misconceptions? You talked about demystifying. What are those misconceptions that you feel most people have when they think about selling a business to private equity?
Yeah, I talk a little bit about it in the book because I kind of have a bit of a play around. There's a bit of fun in the book. It's not just, you know, EBITDA ratios and whatever. Yes. And I talk about the sharks of PE, right? Yeah. This idea that you know, you're going to get eaten alive, I suppose, is one of the things. That is true. I've seen it happen. It can be true. It's not 100% what that environment is like. So I think one of the myths is that, you know, if I sell to private equity, I'm going to get screwed. Yes, it can happen, but, you know, if you understand how that world works and you appreciate it for what it is, it not necessarily will happen for you, right? So that's one of the things. The other thing I think that people kind of think in line to that is that, you know, private equity is the devil incarnate or something. You know, it is unapologetically about money, and that I'm very, you know, happy to talk around. But at the same time, if private equity didn't exist, then a lot of business owners, certainly over the last 30, 40 years, would never have had extraordinary, or in your words, legendary exits.
100%. Because essentially you'd have the public markets up here at really large enterprise valuations, and you'd have the private markets, and there would be very little in between. So
100%. And a lot of the time, if you go back, if you study this back into, say, like before the 1970s, you know, if you exited, then you sold to a competitor and it wasn't usually favorable terms. or you try to give the business to your kids, or you shut it down. So there's
Yeah.
a whole, dare I say, marketplace and economy that's being
Yeah.
built up through private equity that has huge advantages to business owners, again, if they know how the game is played.
Yeah. Two follow-ups and things you shed there. So the first one is, you talked about the perception that people feel they're going to get screwed by private equity. I assume you're speaking primarily about the financial side of the deal. So what are those concerns that you've heard from folks? And now sitting on the other side of the table, if you're coaching an owner who's thinking
Yep.
about that transition to private equity, what do you encourage them to do to make sure that doesn't happen to them?
Well, I think I like to simplify concepts, and in PE we do that. By the way, people think it's complex and everything else. It's not really. Like, everything boils down to sort of first principles of certain things. It's about price and it's about terms, and I'm sure you've spoken about this at length on the show before. But my belief is you can only win one.
Yes,
and
you set the price, I get to set the terms. That's a common sense.
And I always encourage the business owners that I work with to win terms. And there's lots of reasons for that. They come to me normally with the expectation of price, an enterprise value that they want to target. I often say to them, let's have a range, but don't be surprised at the end of this if we're either at the bottom end of that range or even less than the range, but you've got a better outcome overall for you.
100% agree with the focus on terms over price. I assume we're referring to some things like earnouts or equity rollovers, and maybe even getting into the reps and warranties of the deal. What specifically, take us a layer deeper into the terms?
Yeah, it's
what
also it is those things. It is those things, but it's also what happens to my team.
Yes.
What happens to me? What happens to my brand, the legacy that I've created? What is your plan for this business? Right? I know I don't have ownership when I sell it to you, but I'm baton passing, if you understand the expression, the vision.
Yes.
So are you going to take what I've created and expand that? That might be, I'm not saying it's important for everybody, but that might be important to me as the seller. So these are the sort of things that you need to think through. I'm a big believer in selecting your acquirer.
Yes.
As opposed to the other way around. I call it sell-side control. But the idea of that is that I'm not just going to sell my business to the highest bidder. I'm going to be super intentional about all the things that matter to me, and I'm going to select who I think the next best owner is of the thing I created.
I love that. You've actually gone to everybody's focused on the financial piece of a transaction at some point in time, right? Price terms, et cetera. But I do believe, in my experience, and I'm not sure what yours is working with privately held company owners, I do believe that the number two consideration is what's going to happen to the employees. It's the legacy of the business.
Oh, yes. I hope that to be true.
Yeah.
I have seen situations where people come to me just like, I just want the biggest price. And I'm like, do you... Okay.
If you just want the biggest price, we're probably not a fit to work together.
There is a lot of those conversations. There is a lot. People do come to me sometimes thinking that I'm, maybe back in the day I used to be more like that. Certainly in private equity, you're trained to be more detached.
Yes.
But these days doesn't align with values for me.
So walk us through that conversation from two different sides, because again, you've had the blessing of sitting on both sides of the table, as on the PE side and the operator side, and now the advisory side. When a private equity firm is acquiring and they're thinking about the org chart, or they're thinking about the line item of payroll on the income statement, what's the prevalent thought? What are they thinking about? And then conversely, as you're advising owners and you're trying to find that suitable PE partner fit to sell to, what are the 1, 2, or 3 questions that you're encouraging your clients to think about and to discover to see if there's a fit?
Yeah, I think if we talk about people, right, and capability, we're looking at alignment with strategy and vision. So there's, I talk about this a little bit in my book about, the most important person in the business may not be the CEO or even in the C-suite. It can be someone who is, within the business that's totally and utterly important to whatever that business is trying to achieve. So the example I used to work at a business called Getty Images, and I did a lot of acquisitions there, big M&A focused company.
I didn't realize that. I'm very familiar with Getty Images, of course.
Okay, good.
You're in marketing, of course. You've used stock photography. You know who Getty Images is, but I didn't realize that they had done a lot of M&A.
Oh, huge! And it was owned by 2 investment bankers.
Oh,
so they disrupted the industry. It's a really interesting case study. But when I went there, I remember the first week I was there, I met one of the founders, Jonathan Klein. And I'd come from News International previously. So this was my first experience in proper private equity because I'd gone from selling this big media company piece going into that. But Jonathan said to me, he said, you know how you grew things at where you were previously? And I said, yeah. He said, we do it differently here. We just buy companies. And I'm right. What about organic growth? Oh, it's over here. I just want to talk about buying and integrating.
Yeah.
And that's effectively what we did. And I think what's interesting there, right? So back to the question about capability, there was a person in Getty who was in charge of integrations, not a senior person necessarily, like a senior director, but not a VP or a SVP. And at any measure, if you were assessing the payroll and the org chart against the strategy and the vision, that person had a massive line, underneath them, or a circle written around them as being integral to it. So, to your question, everyone thinks private equity looks at the numbers. They do look at the numbers, but they look at the numbers in line with what that's going to drive in terms of the growth strategy. So we don't mind over-investing in areas as long as it's going to get the right level of growth and return based on our investment thesis.
Yeah. What did you find? What was your experience? We make investments today and we see value at a later point. That's always how investing works for the most part, right? So what were the places that you consistently saw the bets pay off where you're like, hey, we're gonna make a little bit more of an outside investment in this piece of the business, and over time, whether that's 3 months or 3 years, you really saw that pay off? Just curious.
Yeah, I tell you the one thing that I saw more than I'd like to admit I saw, which is an investment per se, but maybe not the way you're asking the question.
Okay.
Was changing out the CEO.
Oh, interesting. What?
And I know we'll get into this around sort of platforms and whatever. Hindsight's a wonderful thing. If I look back and think, why was I successful in that environment, is because I'm terrible at starting a company. In fact, get me doing anything like that and I'll probably break everything. Whereas if you get me to fix a company and scale a company, so I did lots of turnarounds, I'm very good at solving problems.
Yeah.
And I think one of the big sort of ninja moves, if you want to call it that in PE, is the thorough assessment of the founder, even in a platform acquisition, and the ability, confidence to swap them out to put in someone else. When that sounds like such a big decision, but when you look at how value is created from those transitions, it's one of the key plays of PE.
Talk about assessing a CEO, because I think this is really interesting for CEOs who want to go through a growth phase, right? So, I mean, step back. One of the things that I believe is, other than business model, people are the number one issue in business. Then it's strategy, because people pick the strategy, right? But so I think just to riff on this for a quick second, we have to have an understanding of who people are: physical, mental, emotional, spiritual. So when you talk about assessing CEOs or founders and sort of figuring out, hey, can they take the company to the next level, or do we need to swap them out? Through what lens were you assessing?
I believe you can only scale a business to the level of your identity without getting too esoteric.
Oh my goodness. You are like with the last guest that I had in this podcast, Chris Smith of the Possibility Company. He says you will never exceed your identity. And Chris and his firm do a lot of work with wealth advisors around creating brand. So back to you.
Interesting. So I look at it through the lens of operations, that being growth, not just, the operating of the business, but how the business can create value. And what I found over the years is the people who start businesses, this is not holistic in terms of this is for everyone. Some people can make the transitions all the way through. It's very rare, but I've seen it. But everything that you did to start a business and get it to a certain level of scale, I feel can fail if you don't understand how to operate with different layers of complexity. Right? So the startup founder, the person who's brilliant at startup, normally they have complexity through chaos and creativity, but they don't have lots of people, lots of systems, lots of technology, all the things that are the blueprints or the foundation pieces of scale. So you've got the situation where I saw this really acutely at Getty, where we acquired, I won't say who we acquired, but we acquired you'd know the name. As soon as I say it, you go, wow. And the person who founded that business was a kind of hipster skateboarding dude.
Okay.
And, he lasted 2 months in that environment. He was so creative in what he created. The business amazingly successful. But in terms of taking that business to the next level in that environment, no way could that person work.
Yes.
So to answer your question specifically, we're assessing kind of 3 things. We're assessing, obviously, capability, right, in private equity, the game is buy and build, right? There ain't just an organic game. It's buy a company and bolt other things onto it. So, is the capability there of that CEO to lead that level of strategic growth, right? How are they going to operate culturally, not just under private equity ownership, which is about governance and discipline, right?
Yeah.
And structure. How are they able to build a company through culture? Okay. Because again, remember, big companies have lots of people. You can't do it just through pure leadership.
Yes.
Okay?
Yeah.
And then the third area is more the emotional intelligence piece, the bit I was just touching on around the identity. So, are they prepared to be the dumbest person in the room? Are they prepared to drop the ego? Are they prepared to realize that the only way they're going to be able to take the company to the next part or whatever is how much they change and evolve, which is the identity piece. So I'm assessing, and when I was doing the operating partner stuff, I would be put in to mentor these founders as soon as we've acquired them. And the first thing that I was doing through that process, and even before we acquire them, was assessing the capability based on what I just said for the next stage.
Now, you've just given so many great nuggets that we could continue to riff on there.
I know there's a lot there, isn't there?
There is. I do want to ask you one last question about the book, and then just pivoting to a related topic. But in the book, Exit for Millions, that you just released 2 weeks ago, congrats.
Thank you.
You talk about the scale to sale methodology that's got 5 different pillars. And so without giving away that whole book, I'm just sort of curious, which of those 5 pillars do you see most, 7-8 figure founders getting completely wrong?
Sure. And the methodology comes from, again, thinking back over the decade or so I was in PE and thinking about what are the things that we did in private equity that I could then build and relate back to founder-led companies and founders themselves. So there are 5 pillars. I'll go through them, but I won't go through them in detail. We can come back and talk about a couple of them. So the first, and it's a sequential order. So the first one is clear end game. So that's simply the reverse engineering on an outcome. And in private equity, we talk about the exit of the business we're buying in the integration plan. In fact, we're talking about it in the 100-day plan. Yeah. And most founders don't do that, right? They don't even think about it. And there's a thesis about, don't worry about the exit, just build a really valuable company. In PE, that's not how we operate.
Yeah.
Okay. So that's the first one. Second one is strengthen foundations. We can talk about that in a second. Before doing anything really fun, like buying other companies and creating a roll-up or whatever, you've got to have a strong base, right? The third pillar is scale fast and build value. I think you can scale quickly once the foundations are in place, and you can start to do more multiple expansion. You can start to do some very clever things that increase the value of the company once everything's in place. So my view is don't scale, or don't even try to scale until you've really done the assessment of what the foundations need to be to drive back to that vision.
Fully agree.
Fourth
so you
area,
have 3. So what's the fourth and the fifth?
Yeah,
now?
Prepare and profit up. So this isn't just about taking cost out. In fact, if you take a lot of cost out of your business before you start a sales process, you'll get penalized in my world.
Yeah.
So it's preparing yourself and your team and the business to go into a sales process. And it's like the one thing I do in that phase, and I'm sure you do it too, is we do a full due diligence process in that. It takes about 6 months, 12 months in total. So that before the business is ever for sale officially, we know that it's going to hit whatever that target valuation is.
Yes.
Yeah. And the last part is I call it exit for the highest multiple or highest valuation. That is the sale process. And I have I don't believe you always have to use investment bankers or brokers to sell a company. I think you can do it with the right advisory team, certainly up to valuations of 100 million, which surprises people, but that's my belief. I've seen it happen. I've helped orchestrate that as well.
I love it. Hey, let's pivot to this bigger question. It's clear you get this amazing, bigger question perhaps for a lot of folks who are privately held company owners who may be listening to this conversation that we're having. And that is, they're thinking about the array of exit strategies, internal or external, right? So they might be thinking, hey, do I want to settle a key member of my leadership team or do an ESOP, or if there's a relative and, family member involved, transition there, or do I want to sell externally, whether that's to a strategic in their industry or private equity firm. So for somebody who's in that framework and they're thinking about the future and they're saying, what am I interested in? What am I not interested in? I'd love to have a brief conversation about what makes private equity the right choice for an owner who's sitting in that evaluation process today. And so first question I want to ask you is this. I assume you would agree that not everybody should sell to private equity. We'll start
100%. And you know what? I've never actually had this conversation before like this.
Okay.
So this is cool, right? And this is, I really want to unpack this because I think it's important.
And I do too, because I think, just to chime in real quickly, at least here in the US, so many, regional consulting firms, national consulting firms, they're inviting their owners to come to these one-day seminars. And the assumption is always that the person is going to sell to private equity. And so that's where I really want to get your take on this, because I think this is an under-talked about topic. Back to you.
Yeah, let's do it. So just to set the stall right here, and this is, if you look at the statistics, this is probably the shocking bit, right? So you're right, you can sell a business to your partner, you can do MBOs and MBIs and all these sort of things, right? I only specialize in third-party sales, so I don't get involved in succession. So I'm talking about strategic and financial buyers. Now, if you look at the statistics and where capital is currently sitting, not just in North America, one of the reasons I'm moving to Dubai is just looking at the family office structures over there. There's a statistic going around that if you want to sell your business for 8 to 9 figures by 2030, 80% of the money that's going to fund that is going to be touched by private equity. Now, that doesn't mean that it's private equity money, because there's still debt and things like that going into the deals. But what it does mean is that private equity has such a hold on companies that if you get bought by a strategic, so another company buys your company, there's a high chance that above the chain, that business or the business that's bought that business is private equity owned. And so your question about should anyone sell to private equity, the problem you've got is that if you don't understand that world a little bit, and we can get into the absolute detail on that, your chances, think about it in terms of supply and demand and the marketplace, your chances, diminish.
Yes.
So
particularly if you want to sell at for more strategic premium pricing. But I think the key point that I just heard from you, Nick, is as we think about third-party acquirers, that really valuable businesses, most of the time they're not individual buyers, right?
No,
it's private equity or strategics, but behind a strategic is most likely a growth capital partner like a private equity group.
Family office or something like that. That's becoming more of the norm. And I look at the trends, not so much the absolutes. And it used to be a lesser percentage a few years back, and now it's increasing. So I think, to go back to your question, not everyone should sell to private equity if it's selling to private equity as a financial buyer and you are the platform. So platform being defined as the first acquisition a PE firm makes in a defined market. And the reason for that is, you're really selecting, you're really entering a partnership, a proper partnership there.
Okay.
And you have to be very, very ready for what that partnership looks like. And, that's things like, wanting to sell your business twice. It's understanding how to navigate the complexities. It's very different. You've got to really prepare yourself if that's your ultimate goal. Whereas you can sell to private equity if private equity has already bought a company that's buying you. And in situations like that, I think there's plenty of good reasons why most founders could prepare themselves for that outcome, as long as they understand what that looks like as well.
So maybe I misheard you there, but you were really comparing and contrasting the idea of being the platform acquisition versus the bolt-on in your answer. And you're seeing a greater level of partnership as the platform acquisition. Talk to me about why you see it that way. Is it the deal structure of how it's put together on a platform?
Well, private equity doesn't exist to run anything.
Sure.
So even as an operating partner, people get confused. The operating partner's job is to mentor and advise, but they're really the planted person to put an insurance policy around an investment. It's usually someone who's exited a company or has operated at a higher level in some area, and they've been there and done it, and they're put in there to make sure that the founder of the business that's been purchased, that platform, doesn't screw it up. Okay.
Yeah.
But private equity doesn't run anything. So one of the things we're doing, I put my PE hat back on, is we're assessing the capability of the leader, often the founder, and the leadership team to be backable to drive the next phase of growth and value in the company we're acquiring.
So very specific question that is a follow-up. So let's say I'm a CEO, I'm a founder, I 100% own my business myself, privately held.
Yep.
And I'm really at the point where I don't really want to continue to, I'm moving towards the exit. I know I want to sell to private equity potentially, right? but I don't want to be in this for the long term, right? I don't want to continue to operate the business. Is it better in that situation for me to create my own successor, train them up as the new president CEO before I ever go to market? Or would you actually say that most private equity firms are really prepared to deal with that, and that's not a deal breaker?
You've got two options in that specific scenario. I'll talk about what I call the three exits in a second, right?
Yeah.
But in that situation, you have to have someone running the company for you, and you can sit as the chairman or whatever else, right?
Yeah.
And you've got to do that with a certain amount of runway before a sales process.
Yeah.
The other option, that's one option. That's you could definitely sell your business to private equity as a platform in that situation, and maybe be an advisor on the board or whatever. You can roll over your equity. I advise on that strategy all the time.
Got it.
The other option, if you definitely don't want to run your business anymore, is just sell it to another company, sell it to a strategic. Be very, very clear that they don't need you. They might need you for a bit of time, but they don't need you forever, because you're just going to be a division, or you're going to bolt into a division where there's already a whole leadership team. So in those two situations, I think they're very great exit strategies for the individual, if you understand that's what your goal is.
Two follow-ups on what you shared there. In that situation, the first situation that you addressed, where somebody's going to be the platform acquisition and they're raising up that successor, it makes total sense that new president CEO needs to be in place long enough to actually execute on the strategic plan, and for that to show up in financial statements for a buyer to have confidence. I think that's the point you're making.
That's correct.
How far in advance of going to market do you typically advise an owner to have that successor in place? What does that look like?
18 months to 2 years.
Yeah.
So not 12 months. So if you bring someone in, you've nailed it in terms of, remember, I'm really only looking at two things, risk and upside. And I get measured on two things. I get measured on a thing called MOIC, multiple on invested capital, which we can define, and IRR, internal rate of return. Sure. So I want to, triple or more the invested capital, and I want to be able to do that in the quickest amount of time. So I'm assessing that, can that team do that, right? And if they can't do that, then I'm not going to achieve my goals.
Yes.
So that's why it's important to really sort of unpack that.
Yeah. I mean, that, in a sense, that's the same things we think about in any deal with any exit strategy, is the reduction of risk and the ability for the upside growth. But you're taking us into a very specific, well, hey, if you don't want to be in the day-to-day, you really want to sit in that chairman role, you've got to bring somebody in. They've really got to be in place for probably
my point being very specifically that if someone's been in there for 12 months and they haven't even run an annual planning cycle or budget, and I'm going to be backing that horse to deliver incredible growth and a significant exit in the future,
that's a risk.
It's a massive risk. I have no visibility or confidence in that outcome.
Yeah, totally agree with us. A little disjointed question, but I just want to jump there because I know it's in the mind of some folks about deal structures, platform versus bolt-on versus the third-party sale to a strategic. What are you seeing real time right now? And, obviously the perfect deal structure for most people, unless they really want to have that rollover and get that second bite of the apple, is they all want 100% of cash up front, up front. So what are you actually seeing on the rollovers in terms of percentage these days? And what's sort of that range? And do you see a difference, whether it's the platform or the bolt-on, or then, thirdly, a sale to a strategic?
Yeah, it's a big question. So I think typically, and certainly in the PE thing, you can expect to get 60 to 70% of cash at close.
Yeah.
Sometimes it dips down to 50, but I'd never advise on that. I think you can always negotiate up to that 60 to 70%. And then you've got an interesting situation, because, the earnout versus the rollover is always one of the things that gets negotiated. I push all of my clients to roll over equity. Okay. Particularly we're talking private equity more so, because sometimes with a strategic, you don't have that option, because a big corporate buys you might get some shares or whatever. But I'm a massive believer in rollover. And the reason for that is you can negotiate, back to price and terms, you can negotiate what that rollover looks like in terms of the share levels at holdco level. If, back to my point around, you choose your acquirer, if you choose the right partner and you believe that they're the next person who should take the business to its ultimate vision, or the next part of the vision, you can get a very, very good return from that. The reason I don't like, and I think you would have talked about this plenty of times, the reason I don't like earnouts is because of the lack of control. And I'll be honest with you, there were certain situations back in the day when I was in private equity where we deliberately played the earnout to make sure that the founder never got paid.
Yes. Yeah. I have a very similar belief system that you need to be content with essentially the cash and the rollover, and the earnout is a really murky sort of thing in the middle. So
yeah, it is. And it's not so much that you can't control the business. So therefore it's more to do with the performance of the business has to be a joint decision, I think, in that point, right? And traditional private equity, you asked the question about, what's it like? In situations like that, they're not very good at committing to what they agreed in the beginning. And if they lose confidence in you, let's say you're not operating very well, the first thing they're going to do is, as I said, find someone else. So you've got to have a lot of protection in my mind around the earnout. Whereas the rollover, it might be a situation where you're not the best CEO to continue this on, but someone comes in who's brilliant and you make a truckload of money on the second exit.
Yeah.
Are you upset about that?
What
Probably
is
not.
again, because you get this perspective on that side of the table, what percentage of the time do you feel that rollovers have worked out really well for sellers? And typically, what kinds of returns have you seen, having worked in that space for over a decade?
Yeah, so I have seen people sell their business a second and a third time. I've definitely seen people sell their business a second time and make more money than the first time.
Yeah.
I wouldn't say that happens every time. I would say it's rare. I've also seen people lose, their money as well because they weren't, they didn't really understand what that whole world sort of looks like. So this is a really interesting area. Back to my sort of thought about you've got to know the rules of the game because understanding these are questions that you can ask all the way through the sales process. And depending on your level of confidence based on the response, defines whether, you feel that you want to commit these terms as part of the deal.
Yeah. We've talked a lot here about price versus terms and earnouts and rollovers. I want to go back to, in wrapping up the segment, I want to go back and I want to talk a little bit about, weave together a couple of concepts. You said the first of your 5 pillars on the scale to sale methodology is a clear end game. That resonates with how we work with clients to legendary exits, but I think we probably think about it a little bit differently. One of the concepts we talk about is every founder, if they're going to exit, they have to have a radically compelling personal vision for their life of what they're going to do after the exit. For multiple reasons. One, to avoid regret. But what I've just seen over the years is it's always fun to talk about the exits, but if it's not really clear and bright and visualized, if the future is not better than today, there's no reason to go to the future. I have this conversation all the time with founders. They're like, hey, it sounds cool to get a $35 million, $50 million check. I have no idea what I would do next. So I'm sort of curious, how does a founder's vision for the future, where would you see that as compatible and incompatible? Because we've talked about situations of being a chairman, situations of staying on board and running. Again, in this sort of decision, is private equity the right sale for me or not? You're speaking to an owner right now. What things in their future vision personally would make it incompatible for them to sell to private equity?
I mean, I talk about this. It's the last chapter of the book, actually, in terms of, it comes a little bit back to identity as well. I think one thing that I remember around private equity is this concept of precision, discipline. It's high stakes gambling at the best of it. And if you're excited about building a massive empire, potentially becoming a billionaire, money is very close to status. And all of those things actually matter more than maybe other choices. Maybe they matter more than freedom, right? Because once you get into that world, you're kind of signing away. Even though you might have a lot of money, you're buying into a code, like a club.
Yes. And
that's not free necessarily, right? There's certain things that you can and cannot do in that club. So but that club might be the gateway to something that you couldn't achieve by yourself. So people who come to me and say, I just want to create expansive amounts of wealth, or I want to go and make a bigger impact, but I need to have the capital resources to do that. quite often private equity can be the vehicle for that more than anything else.
Agreed.
Right? But the opposite to your question, if you value freedom, flexibility, lifestyle, if you do have a clear view that is, I don't really want to be involved in my business anymore, I just want to play golf or go on holidays, and I want to kind of see my family again because I haven't seen them for years. If you've got all those things in your kind of future vision, then I would advise not going through private equity. Private equity is very linear and very good at doing the one thing that you expect them to be good at, like world-class. If that's not high on the list of your values, using that term in that way, then it's probably not going to be the right fit.
Yeah, the rules of the game are clear when you bring in outside investors. And I think that's a big emotional and tactical day-to-day shift. If I own the business 100%, I get to decide what to do, right? I can distribute cash, I can fuel growth. But once you bring in outside investors, that's a totally different game, right?
Yeah, I talk a little bit about lifestyle businesses versus performance businesses. And the definition, lifestyle, obviously you have the ability to enjoy your business because you're taking the money out to fund your lifestyle. But performance businesses, you're driving for a big capital result or a liquidity event. And I say to a lot of people, because they come to me and say, "Oh, can you help me raise money?" And I'm like, "Do you want to do that?" I mean, you realize as soon as you do that, I don't know an investor who just wants to cash flow. They all want this big event.
Agreed.
And that can be a very painful process if you're not ready for it.
Yep. Fully agree. Hey, let's pivot maybe just for the last few minutes to talk about different kinds of acquisitions that private equity firms make, specifically the platform, that first acquisition in an industry as you described it versus the bolt-ons. What makes for a good fit? Is it size of company? Is it certain characteristics? What is your experience, share with you, and how can you share that with us? How does somebody know, hey, my business could actually be a platform and a bolt-on, and what are the differences between those?
Yeah, so one of the terms I've used a lot in private equity is we call it the Franken-Business, and it's kind of what it sounds. It's the Frankenstein, right? Like, what is Frankenstein? It's all the bad bits bolted together to create a monster, right?
Yeah.
What I have seen happen is people get really trigger happy about acquisitions, but they've got no strategy around the acquisitions. So they just buy businesses thinking they're going to aggregate EBITDA, and then they try and sell the group, and it's a mishmash of stuff, and they get a terrible multiple if they can sell it at all, because half the time it has to be broken up. So in my mind, let's talk about the bolt-ons. What does a great group of companies look like? And one of the things you'll get asked, if you ever get to sell your business to private equity, usually, in my experience, the first question you'll get asked is share with me the vision you have for this. And it's not as a simple a question. Like, if you answer that question wrong, the conversation's finished. What they're really asking is, show me what this thing looks like when it's, expanded. What geographies are it in? What other products and services can we deliver? What other customer segments? It comes back to your point around business model. And I believe 100% that the most important thing that anyone should talk about is their business model. But private equity looking to expand the business model, right?
Yes.
So your strategy around what companies you should buy, particularly if you're looking for acquisitions to scale before, potentially selling to a PE firm or strategic, needs to be well constructed around what the vision of the business model is. So, should I buy competitors? Well, that depends. Are they going to open up a geography that's important? Should I go and buy up and down the supply chain? Well, that depends. What does the vision of the business look like, reverse engineered, once you have those capabilities in your group? Yeah, like I do a lot of stuff with agencies, and marketing agencies love this idea of consolidation, and they just want to buy other agencies. And then you end up with a full service agency, which doesn't serve anything, and then it's not low value. So I normally have to go in and say, what's the overall value proposition of this group?
Yes.
Right? Who are we serving? What does it matter? And then let's go shopping based on filling the gaps in that. So hopefully that answers the question, but it's not just about aggregating profit and making a bigger profitable entity. It is about that, but it's also about the interrelations and dependencies between the companies when you put it together.
So I think your response there was really about the bolt-ons, correct? And it's just saying, hey, if a private equity firm wants to get to a total amount of EBITDA, let's throw out a number. Maybe it's 50 million in aggregate annual EBITDA. It's not just about getting to that number. It's about how every acquisition is going to expand the geography of the overall brand, how every acquisition is going to expand product and service offering or go up and down the value chain. Where there's going to be a strategic reason for acquiring that EBITDA, not just the dollars of the EBITDA.
It's the thesis of the whole thing. So I'll tell you about one of my biggest exits, $2.3 billion,
Cool.
a company called Ascend Learning, owned by Providence Private Equity, sold to Blackstone. I was the CEO of the international division of that business. Okay. So there was a group CEO and I was like a divisional CEO. Now, that started with a acquisition. I think it was Jones and Bartlett Publishing was the first acquisition. I could be wrong. But we ended up buying a whole heap. It was actually 12 acquisitions. But each of those businesses, the thread, and this is the important bit, the thread was accredited learning. Education technology, but accredited learning. So if you had to have a license to practice, then we wanted to buy you because, it's a little bit like what we were saying with the Exit Planning Institute is trying to do. But it's if you want to be a nurse, for example, we had a company called ATI. I sat on a group of businesses called Global Fitness and Wellness, and one of them is NASM, North American Sports Medicine. So if you want to be a personal trainer, you've probably got an NASM qualification.
Yes.
So the thread in that, which created all the value, was this idea that every business has to be in that lane. And that's what I mean, a good strategy.
Yeah. As opposed to, hey, we could do education, but it's not supporting certifications or requirements.
And I'll tell you what happened at the end, right? So this is interesting.
Yeah. And
I'm
really interested in this, by the way, because I was a CFO of a 50, we grew a company from like 10 to 50 million in top line revenue, but it was non-accredited online learning. So continue.
Yeah, it's an interesting space. I mean, we ended up, I think that one of the main reasons Blackstone bought us was the data that we had. But we had a couple of businesses in that roll-up that they just weren't really aligned to the accredited learning license to practice. We had 2 or 3 absolute stars, and then we had a few that were early acquisitions. And we ended up with one of them. This is crazy when you hear it. It was still quite profitable business. We had to turn it into a service arm of the other businesses. So when we did the valuation, we couldn't really tell the story that it was part of the group, but it did provide resources and capability. Remember, it's an education business, so it created certain assets around courses and curriculum and things like that, because it was the publishing part. But it wasn't sexy enough in terms of technology and data for us to be able to put it into the exit story, which you haven't talked about. Yes. And it was the exit story around education technology and data that got the high multiple.
Okay.
Had we have not done that, we would have got a lower multiple. And in situations where this was in the billions, every point on the multiple was worth hundreds of millions. Crazy when I know that's maybe a long way away from what a lot of the listeners have probably even thought about, but the principles are the same, even with a smaller business.
Absolutely. This is really great. So we've talked a little bit about platform we've talked a little bit about the bolt-on.
Yes. Yeah, we have to come back to
platform. And, I guess one question I've got around that, or I'm sure listeners have this question is, okay, I'm sitting here today. I know that I'm interested in selling to private equity. Can I really do things today to position myself as to be the platform versus a bolt-on? Maybe you can speak to that as you speak about platforms.
Yeah, so I'm going to put some numbers on this because again, my experience is there's a piece where the reason why 2 out of 10 businesses never sell is they never get to scale and they never open up the marketplace. And in my experience, if you're less than say 5 million of EBITDA, and even that's touching it, you're too small for us to be interested. And I was always taught in my PE days when I was there that it takes just as much effort to buy the small business versus the big business. So we don't want to waste time. We want to deploy as much capital. We're not scared about deploying lots of capital. The other thing is the business that's a bit bigger in terms of its profitability is more predictable, repeatable, and sustainable.
Yes.
So if you want to be the platform, the first thing I say to people is let's get you above 5 million of EBITDA. Okay. There's obviously a lot more.
I have a very similar thought, but continue. Yes. I said, say some very similar things. Yeah.
But you know what's really cool when you walk, I work a lot with business owners that have just got over that 1 million of EBIT. So they're 7 or 8 figures, but they're usually in that point where they've suddenly got resources. They've got capital they can invest. They don't have to go and raise necessarily.
Yes.
And so I say, okay, well, listen, if you want to sell to PE and we're clear that that's the right outcome for you, or you want to have it as an option, let's get you from 1 million to 5 million. And you know what? That conversation I find is quite an easy conversation. They go, so what you're saying to me is all I need to really do is think about how I get the profitability up from where I am now. So yeah, now let's talk about how we do that. And that's the strategic.
magic, and that's where the devil is in the details.
Yeah, and that's where the acquisitions might come in, and that's where you start to think, well, actually, if I buy that company, I'm going to add 500K or $1 million of EBITDA, and then you literally just build it like you would build any machine. Like, you have a strategy around how you would execute.
Yeah, we
so
do. I think if I just jump in here, I think it's important to have that clear vision of the destination and reverse engineer.
Yes.
And so one of the ways that we do it, and you probably do it the same way, is from the financial side, show me on a single spreadsheet, a single table, how are we going to grow enterprise value from present value to future value? And is it going to come from organic growth or inorganic growth, like you're speaking about? Or is it going to come from, growing profitability as a percentage of revenue and multiple expansion, right? But there's sort of this recipe that you start at, in one sense, at the financial level, and then you bring it down into very practical plans. I don't know.
Yeah, it has to be. If you look at the 100-day operating plan from PE, it gets into that level of detail. It talks about pricing strategies. It talks about organic growth. It talks about partnerships. It talks about potential acquisitions, or certainly the categories. It talks about operating margins and efficiencies. It talks about capability gaps. It's it's like an architect's drawing of a house. The level of detail is down to the color of the walls and whether you've got polished concrete versus wood, right? And most business owners,
when you say an architect's plan for the house, because in our business we say we help owners architect legendary exits.
Okay,
and then we empower them.
So there's a lot of. I'm sure the stuff that you do brilliantly is very similar. I mean,
yes,
I think my big mission, more than just leveling the playing field, and that is trying to bring the playbook to founders. So that they can really appreciate what is the best thing about private equity. I think is their ability to scale companies quickly. And that's such an important thing for business owners to learn.
Yes. So Nick, let's riff. I know our time's coming to a close. Bringing that playbook to founders. This has been an amazing conversation. I've learned a lot from you with your very specific experience, particularly around private equity. How can folks connect with you after today? How can they get access to you and to your guidance? Obviously, you've got a book that's available. Maybe tell us about that. But
sure.
How do people, connect with you if they want to learn more? And
so there's three things. Definitely the book's brand new. It does. I think we've actually gone into more detail. Your questions have been awesome. So we've gone into more very practical detail. I tried to make the book something that wasn't, War and Peace. Right.
Yeah.
But you can get the book on Amazon, Exit for Millions, Nick Bradley. So grab that if you're interested. I've had a podcast since 2019. It was called Scale Up Your Business. It's now called Scale Up with Nick Bradley. 392 episodes. And it covers a lot of the private equity experience. But, I do a lot of solo episodes, and I educate through that. So I often say there isn't one area of business over 400 episodes that I haven't touched on. I even get into things like fear and identity and how to be a great CEO. And there's some of the mindset elements are in that as well. So if you're interested in that, go and have a listen. And then I hang out a lot on LinkedIn. That tends to be where I am. So if people ever message me there and want to say hi, they heard me on the show, I always get back to people. Not always as quickly as I'd like, but I always come back. So if you liked the conversation and you want to kind of get in touch and say hi, then that's the place to find me.
Wonderful. So a book, 392 podcast episodes. That is a whole lot to take in and to learn from you on, and then connect with you on LinkedIn. Nick, it's been great to have you. And thank you. This has been a wonderful conversation today.
Yeah, thank you very much. I've enjoyed it. Great questions, as I said. Thank you.
Thanks for joining us on Legendary Exits. We hope you enjoyed the conversation. If you did, give us a 5-star review on your favorite podcast platform, and be sure to subscribe to the show to stay connected with more stories of purpose-driven exits. You can find more information at legendaryexits.com. Until next time.